AT&T, the name resonates with a legacy of telecommunications dominance. A powerhouse for decades, AT&T now finds itself navigating a rapidly evolving landscape. The company is no stranger to transformation. However, today's challenges are unique and demand a keen assessment of its future prospects. Can this giant adapt and thrive in the face of fierce competition and technological advancements? That's the billion-dollar question. Let's dive in. Investors are wondering if AT&T can maintain its dividend while pursuing growth. The company needs to balance rewarding shareholders with investing in the future. 5G, fiber optic networks, and streaming services are key areas of focus, but these ventures require substantial capital expenditure. Tough decisions lie ahead for AT&T's leadership team. The stakes are high. AT&T is a cornerstone of many retirement portfolios. Its dividend is a lifeline for income-seeking investors. But past performance is not indicative of future results. A clear-eyed view of AT&T's financial health is essential. AT&T's recent financial performance presents a mixed bag. Revenue growth has been sluggish, a worrying sign in a dynamic industry. The competition is relentless. Verizon and T-Mobile are formidable adversaries. Cable companies are also encroaching on AT&T's turf. This pressure is evident in AT&T's earnings reports. While AT&T has managed to maintain profitability, its margins are under pressure. The cost of deploying and maintaining a nationwide network is enormous. The race to 5G supremacy is capital intensive. AT&T must find ways to boost revenue and control costs to improve its financial standing. One bright spot is AT&T's wireless business. Demand for mobile data continues to grow. 5G adoption is gaining momentum. AT&T is well positioned to capitalize on this trend. However, the growth in wireless needs to offset the decline in legacy businesses like landlines. Let's talk dividends. AT&T boasts a juicy dividend yield. Income investors drool over it, but here's the caveat. A high dividend yield can be a double-edged sword. It's tempting, no doubt, but it can also signal a company struggling to grow. AT&T's dividend payout ratio is alarmingly high. This metric tells us how much of its earnings are being paid out as dividends. A high ratio, like AT&T's, means there's little room for error. Any hiccup in earnings could jeopardize the dividend. Investors need to ask themselves, is the dividend sustainable? Can AT&T maintain its current payout ratio while also investing in future growth? These are critical questions with no easy answers. Debt, it's the elephant in the room. AT&T's debt load is massive. Years of acquisitions and aggressive spending have taken their toll. The company's debt-to-equity ratio is a cause for concern. It signifies a high level of financial leverage. This mountain of debt limits AT&T's financial flexibility. It restricts the company's ability to make strategic moves. Debt repayments consume a significant portion of cash flow. This leaves less money available for investments in growth. AT&T is acutely aware of its debt burden. The company has pledged to reduce debt through asset sales and cost-cutting measures. However, deleveraging takes time and discipline. It remains to be seen if AT&T can achieve its debt reduction goals while maintaining its dividend and investing in the future. Don't count AT&T out just yet. The company still has some significant strengths. Its wireless network is vast and reliable. AT&T has a long history of innovation. The company's brand recognition is unmatched in the telecom industry. AT&T also benefits from a large and loyal customer base. Its subscription-based business model provides recurring revenue. This stability is attractive to investors seeking consistent income. Furthermore, AT&T has expanded into new areas like streaming and entertainment. Warner Media is a valuable asset with a vast library of content. The challenge for AT&T is to leverage these strengths effectively. it needs to find innovative ways to monetize its assets and attract new customers. The company must also adapt to the changing media landscape and compete with streaming giants like Netflix and Disney+. AT&T faces an uphill battle in a fiercely competitive market. The telecom industry is notoriously cutthroat. Price wars are common. Customer churn is a constant concern. AT&T must constantly innovate to stay ahead of the curve. The decline of landline phone service is a major headwind for AT&T. This once lucrative business is fading into obsolescence. The company is losing customers to wireless and internet-based phone services. This trend is unlikely to reverse. Network maintenance costs are a major drain on AT&T's finances. Upgrading and expanding its infrastructure is essential but expensive. The transition to 5G is capital intensive. AT&T must balance these costs with the need to remain competitive on price. So, is AT&T a buy for dividend investors? The answer, like most things in investing, is nuanced. AT&T offers a tempting dividend yield, but it comes with risks. The company's high debt load and limited growth potential are concerning. Investors seeking immediate income might find AT&T attractive. However, those with a long-term horizon should proceed with caution. AT&T's future hinges on its ability to navigate a challenging landscape. It must reduce debt, reignite growth, and adapt to the evolving demands of consumers. AT&T is at a crossroads. The decisions it makes today will determine its fate for years to come. Investors should carefully weigh the risks and rewards before making an investment. Want to stay updated on the latest investment trends? Subscribe to our channel for more in-depth analysis. Let me know your thoughts on AT&T's investment potential in the comments below.